All right, so in today's video, we're going to take a look at 0 DTE SPX iron condors, how to build one on the SPX. And I'm going to show you the construction behind it and just some general concepts on how they work. Now, one big thing to keep in mind on the SPX iron condors is that when you're looking to build SPX or doing 0 DTE, it has a high degree of price risk. So you want to be exceptionally careful and mindful how much money and capital you put in. So if you've got only a $10,000 account and you put in like $9,000 in 0 day, that can be exceptionally risky. So be very careful. Anyways, if you want to learn more about a lot of the trading courses and things that I have available, I'd highly encourage you to check out tradersfly.com. There's a lot of knowledge and information there, specifically even about trading iron condors. Anyways, let's kick things off and we'll go to building an SPX iron condor. So we're going to build something like this. Now, before we build this out, I want to explain to you how this works and operates and what you're really doing with a 0 day option or an iron condor for that matter. So what an iron condor does is you're looking to sell options premium outside the current price. So the current price right now is somewhere over here, which is 44.51. And that is the current price. And we're looking to sell some premium on this left side, which will be our put side, and the right side, which will be the call side. And by selling that premium, you get a decay, in this case, $250 of decay per day. Now, this is a 0 day, so you're decaying fairly quickly. There's no hourly breakdown. What we have here is $125 of credit that we're receiving. And I've got 2 contracts. Now, if I do 1 contract, that's 125. So the theta there's should be about 125 or so. So we're trying to profit about $130 on this option contract. Now, the way that we construct it and do this is that we go into SPX. So we'll go up here at the top. We'll type on SPX. If SPX is too large for you, you could aim for SPY, which has quite a handful of options as well that you could trade. But we'll go with the SPX. A lot of people like to trade the SPX 0 day options. I know it's very popular these days. And then what you'll do is you'll go down and you'll look at the put side and the call side. So we'll start out with the call side because most people are familiar with the call side. So we'll build out the call side first. Okay, so with the call side, current price is 44.52. And if you're thinking the market stays stable, well, you could choose it based on the delta. You could choose it based on expected move, about $13 or $15 is where it may go. And you'll go into around this level between a 20 delta, 12 delta, somewhere around here. We can go to a little bit of a more, hey, caution one in case you think the market's going to pop, you'll go over here. If you think the market's going to sell off, you could get a closer one. So we'll click this. This will be a 12 delta, and then we'll buy the other one. We can analyze this trade. So this is a vertical. So this is one side of the trade, and this makes it a little bearish. By selling a call vertical, we have a bearish spread constructed. And then we can do the same thing on the put side, and we can construct something around about a 15 delta here. So we'll do this one and this one, just do a 5-point wide difference. Because if we go too wide, that could increase the risk a little bit. And now we've got the other side. So the put side gives us a little bit of a bullish take on it. So we make about $60 from the put side, 45 from the call. Usually you'll make more on the put side because, well, puts are often more valuable in general. And now we've got this iron condor. So if it goes a little to the left, a little to the right, we're okay. But if it goes too far, then we have a problem. But what we're trying to do is have it decay. The amount of risk here is around $400 on trying to make about $95. And then you could put this on and it expires today or really tomorrow. And it's kind of done. So the one good thing about these 0 days is that the options expire today. So there's no overnight risk in doing something like this. Now we could construct this as 2 vertical spreads, doing the call side and putting that in and doing the put side and putting that in. But the better approach is often to just do both of these at the same time. So we can sell this, buy that, and then we can sell this one and buy that one. And I'm just holding the control key as I click the different ones. The other approach is just right click any one of these, sell, and then go to iron condor. It's off my screen here, but there it is. It'll be iron condor right there. And then then you can build the construction from there, selecting your strikes. It takes a few extra minutes, but that's okay. So now we've got this iron condor set up. We're trying to collect about that dollar. We can push that order through, put it in that margin account. And once you have that filled, then it's already time to really start looking at it to get out, because these trades do move pretty quickly. They decay pretty quickly. You could try to run it to expiration, but it's one of those things that you got to keep an eye on if you're trading 0 days, because they can move on you because you don't have a lot of range with 0-day trades. So your big range here is just a few strikes in. So you got a 4435 and the current price is 4452. So any big move up or down could actually cause this trade to fall apart. But one of the things you could do is peel off your position. Let's say you start with 2 contracts. You could, if you start seeing profitability fairly soon, you could peel it off to go to 1. That's one way to do it. You can also set a max stop or limit is probably the way to approach these, because if you don't, you do have a high degree of risk or capital at use for what you're actually making. So let's take a look at this trade, for example. We're actually risking 410 to make maybe 90. So if this trade gets down to maybe about let's say $150 loss, $120 loss, you could take it off. So where do you choose that? Well, you could go, if you're trying to make 90, well, you could go 2 times this, so that would be 180. So the loss would be at about 180. That would be over here. Yes, it's past this zone, but it's over here because that way it gives it a chance to come back into it and maybe snap back, right? Because stocks often get oversold. So you could put a stop in place, something like that, like a 2 times the credit you receive, or you could set a dollar value yourself. Some people also use the delta, like let's say the short delta 12 turns into about a 35 or a 40. That could be another approach to doing it. So I still didn't get filled, but this is the approach you would take. And obviously this is a paper account just to show you how the spread would go, and give you a little insight on putting the trade on and how you might construct it. As far as basic management goes, that's also a few ways that you might go. So anyway, I hope that helps, gives you a little bit of idea on the constructions and the basics behind it. Truly appreciate you sticking with me. Feel free to visit our webinar website, tradingwebinars.co. There's a lot of free webinars on there, and then you can get some freebie mini video courses and that kind of thing to continue learning and on your education. So thanks for joining me, and I will see you on the next video.